there's no valuation support under the stock market. There's none. Earnings are critical, but the earnings you're seeing now are so dependent on the sustainability of fiscal spending, which is, over 6 trillion. This was 4 trillion before COVID. Sustainability of that spending, sustainability of debt growth, and the sustainability of asset inflation to maintain the consumption and the margins you're seeing today, which we believe, again, very unsustainable. There's a lot of room for stocks to fall to get close to any kind of valuation that makes sense on normalized earnings.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Growth stocks have far outperformed value stocks in recent years, and similarly, large cap stocks have trounced small caps. Will that dichotomy continue, or will the pendulum finally swing back to give value and small cap investors their day in the sun? For perspective, we welcome Eric Cinnamon to the program today. Eric's the founder and CEO of Palm Valley Capital Management. Eric, thanks so much for joining us today.
Adam, it's a pleasure and I'm honored to be on your show. Thank you for having me.
Well, thank you. Yeah, as I told you when I reached out to you that I got to give Dave Collum credit for putting you on my radar. You're smirking as you hear his name. Anybody who knows Dave reacts that way. He's just a completely acerbically tongued, very intelligent, very funny professor of chemistry, I believe, from Cornell.
Yes.
Very outspoken on X as well. But anyways, he DM'd me and he said, I should look into you. He said, quote, I think he's one of the most thoughtful small cap analysts and is sitting on a lot of cash, which means he shoots only when he sees the whites of their eyes. I'll give you a chance in a second to say whether that's an apt description of you or not. But one, I want to thank Dave again for putting you on my radar. And secondly, to kick things off here, since this is your very first time on the program, just answer, if you can, my general opening question I like to ask all people that I meet for the first time. What's your current assessment of the economy and the financial markets?
First, I want to thank Dave. That was very nice of him. I always enjoy his podcast, so I hope I can live up to his standards. But as far as the financial markets go and the assessment of the economy and the markets, we view things from the bottom up of the 300 small cap companies we follow that are on potential buy list. So we always view the economy, earnings trends, anything you can think of under the sun, under the financial sun. Our view comes from the companies, and what the companies are saying right now or reporting is a very mixed bag. You kind of have the have and have not economy with businesses, just like you do with consumers. Some companies are doing very well, generating record profits, record margins. Others are in recession. Consumer discretionary is not doing well. Transportation is not doing well. Employment staffing companies aren't doing well. And then there's infrastructure, defense spending, aerospace, anything tied to the build out of AI, doing very well. Higher end retail is doing well, higher end consumer. So it's a mixed bag. And when you look at things in aggregate, the economic numbers may indicate that we're in a continued expansion and it looks healthy. But from the bottom up, there's a lot of trends right now that we view as unsustainable and potentially will lead to more recession, more like a recession.
Okay. Let's see here. I want to dig into that. Maybe real quickly before we do. Your firm there, Palm Valley Capital, the little bit I know that it sort of strikes me as kind of like an old school value investing shop. And as I mentioned in the intro, value hasn't done great relative to growth in recent years, maybe because of some of these unsustainable trends you're talking about. But can you just give us a real quick sense of sort of how you guys approach value investing and how you see value investing in, like, where it is in the pendulum right now of Wall Street? Is it just, I've seen memes on TikTok where people say this is the best financial decision you can make, and it's a photo of somebody throwing Benjamin Graham's Intelligent Investor book in the trash. So, I mean, is it really on the outs? Are we in a totally new world, or what?
I got to get on social media. That sounds like fun. Um, yeah, so we're an absolute return strategy. We focus on small caps. We launched in 2019, and if you think about all the trends right now in investing, active is out, value is out, small cap is out, absolute return is way out, and we decided to launch a small cap absolute value fund. So yeah, so probably not the best timing, but it's been really rewarding, been great. But I would say value for small caps, anyways, has significantly underperformed. I mean, I don't think people realize small caps in general have not gone up in price in 4 years. It's been flat to down for small caps. Actually, it's the Russell 2000 is down over the last 4 years. S&P 500 in the same period is up 50%, and the Nasdaq 100 is up around 60%. So huge dispersion in performance, but that's relative performance. We're focused on absolute returns. So just because small caps have underperformed by that much, it doesn't mean they're cheap. It just means you have a section of the market, the mega caps, in the concentrated sectors in the S&P 500 and the Nasdaq 100 that are extremely overvalued. But again, this is in 1999. In 1999, small cap value stocks were extremely inexpensive. People were chasing technology, large cap growth. Coke and Gillette were over 50 times earnings. It wasn't just tech. A lot of the large caps were doing well. Small cap values left for dead. Trading 10, 12 times earnings on normalized earnings, very consistent businesses. Those higher quality small caps today are extremely expensive in absolute terms. So while small caps are, we believe attractively priced relatively, doesn't mean they're absolute values.
Okay, and so at your firm then, what are you trying to do? Are you trying to suss out the most attractively valued small cap firms on an absolute basis, and then hope that A, those will outperform over time, and then B, hope that the small cap sector will collectively overperform the larger caps at some point as the pendulum swings back?
Yeah, well, we're absolute return focused, and for us, what that means is generating an attractive absolute return over a cycle. Uh, our goal is to achieve a 10 to 15% return on our equities. When we're unable to achieve that through that opportunity set, we talked about the 300 names earlier. Instead of being invested just for the sake of being invested, we'll hold cash. So we'll refuse to overpay, still achieve that 10 to 15% on the equities, or we have so far. In fact, quite a bit higher than that. But what we'll do is, that cash weight can lower our returns in the near term, but we'll protect capital when valuations make more sense. And then we get invested once we're able to achieve our absolute return goals. And then over a cycle, it should, in theory, look pretty good. Since inception, we've achieved small cap returns slightly above. So on a relative basis, we've outperformed, but that's not our goal. But we've only been 25% invested since, over the past 5 years. So we've done it with quite a bit less risk. So you could still do well relatively in this strategy, even though that's not what we're trying to do. But over a full cycle, we want to do really well. And to do that, we believe, especially this cycle, given the valuations, that we have to be patient, because valuations for most stocks in aggregate are above or at or near past cycle peaks, bubble cycles where you've lost half your money. So one of the reasons we launched in 2019, and the timing of that, was to take advantage of what we believe is going to be an extremely opportunistic period when this cycle, which we believe has been driven by many unsustainable variables, eventually ends. People will call us perma bears. We just, during COVID, we did do some buying. We got half invested. But we have not been fully invested since inception, and we may be called bearish for that. But all we're really doing is we believe in cycles. We believe in human nature. We believe in greed. We believe in fear. All we're doing, a lot of what we're doing is normalizing in our valuations. We're not extrapolating peak results by companies, and we're not getting depressed by trough results. So we're really just believers in cycles, and we tend to profit from that, or that's our goal. But of course, for a very long time, we haven't had a cycle. So it hasn't been a strategy that has been ideal for an environment where you have a perpetual bull market. But we have had events. We've had COVID, we've had higher rates for longer, tariffs recently. So there's been enough volatility, at least since inception, for us to get enough invested to where we've been able to hang in there.
Okay, so it sounds like Dave was accurate then in his comment where he says he thinks you're sitting on a lot of cash. Sounds like you are. And if you are a cycles player, I guess sitting on a lot of cash at this time makes you think that we are at a relative extreme or near a relative extreme on the valuation cycle on the overvalued side of things. Is that a fair observation?
It is fair to say we believe stocks are overvalued, significantly overvalued, and a lot of that stems from, and that's from our opportunity set. We're not making a market call just on the companies we value, and that stems we normalize earnings. You don't want to value a company on peak margins. You don't want to value them on trough margins. You want to value them on what they should earn over a full cycle, profit cycle. So because we do that. During peak margin periods, we will not be using, say right now, stocks or equities margins are 14%. Historically, they're 8. We're not going to use 14 to value these companies. We're not going to use 4 either, but we might use, say, 8 to 10. And if you use 8 to 10 right now, earnings are nowhere near where they are currently. So by normalizing, we're coming up with lower valuations than what the market is currently pricing in.
Okay. So if it's sort of a waiting game at this point in time, in other words, I mean, you are investing in the companies where you see value right now, and you've got some percentage of your portfolio that is long, but you got a lot that's sitting there in cash. What are you watching most closely here? And if you had to guess right now, what are your leading candidates on the triggers you think that would lead to some sort of, downward repricing of today's valuations?
Well, first, we do have some invested now, so we are finding some value. And I want to be clear about this: is the quality is extremely expensive in small caps and large caps. So what we really want to do, we rather fill up with quality. We don't want to buy a lot of companies with a lot of risk because we're absolute return. So we don't have a lot. We historically haven't made big mistakes, and that's very important when investing for the long term. So. So the quality side right now is not in our favor, but we are finding ideas and opportunities in companies that have operating risk or financial risk. We never combine the two because that's when you can have a goose egg. But on the operating risk, that is the volatility of cash flows. So a cyclical business, we own Heartland Express. It's a trucking company. They have quite a bit of operating risk. It's a volatile business. And then we own Flowers Foods. It's a bread. It's one of the market leaders in bread. They make Dave's Killer Bread, Wonder Bread, Simple Mills, which I really enjoy. But anyways, they have some debt though, so they have some financial risk. So we're finding names, opportunities with operating risk or financial risk, but these aren't names that are going to be big weights. We're not going to have a 4 or 5% weight on the Heartland Express, even though we like it, and a Flower Foods because of the risk. Those big weights we save for higher quality names, which again at this time are extremely expensive. You look at something like a Costco. This is large cap. I'm just bringing it up because I think people are more familiar with a Costco. 50, 60 times earnings. Wonderful business. Benefited greatly from inflation. They were able to not only maintain their margin or profits, but maintain their margins. And in an inflationary environment, that's a really big deal. But so they had a huge earnings step up, but now it's trading as if that sort of growth will continue. People are extrapolating that instead of saying, wait a minute, maybe they just benefited from this period of inflation and that will not be perpetual. So anyways, long story short, we're about 75% cash now, T-bills. So, quite a bit, or I should say, as of last disclosure, we can only disclose what where we've been, not where we are, where we're going. Um, but there has been volatility recently, so I would say that you could expect us to have found a few more ideas along the way. But overall, the market remains very expensive on a normalized basis.
Okay, so I'm just going to pull on that question a little bit more, which is what do you what right now, and I know I'm asking you to guesstimate, nobody knows, but what right now are sort of your leading contenders for what you think might start to bring valuations down? Is it tariff risk and maybe tariff-induced price shocks? Is it just higher for longer bond yields, maybe even bond yields that continue to creep up? Is it a struggling consumer and we start seeing, just retail sales and the purchasing demand from the consumer dwindle here? Is it a full-blown recession? Like, what are the things that are on your current watch list that you think could be the most likely candidates for creating some more valuations in the future that are more attractive to
Well, Adam, I would have thought 9% inflation would have done it.
you?
And the delayed response by the Fed. But a lot of the risks you mentioned are all valid, and it's one of the reasons, we apply a risk premium for owning equities. It should have a higher return than risk-free rates. And you're not seeing that right now. If you look at the Schiller PE right now, it's 37 times, uh, second highest ever behind the tech bubble. We haven't had a recession in 10 years besides COVID, so the Schiller PE really isn't even normalized. It's 10 years of expansion, so that's abnormal. So even using that number is insane. And then you have price to sales now 3 times on the S&P 500. Historic bubbles have peaked around 2. Market cap to GDP over 200% now. Past bubble peaks 100, 150%. So all these valuation metrics suggest we're in an extremely rare territory as far as valuations go. But what causes that valuation excess to revert or even go below normal is unknowable. But many of the things you mentioned, I think, are leading candidates. Underestimating inflation is obviously one. Letting it run too hot for too long. The debt obviously is unsustainable. We believe. I mean, I think a lot of people believe that. The fiscal deficits, if you look at profits right now, they're almost perfectly correlated to government debt growth and fiscal deficits. I think people underestimate the power fiscal deficits and government debt growth have had on earnings, just like they
Mhm.
did in the mortgage debt bubble. Mortgage debt went from 7 trillion to 14 trillion. Government debt's gone from 10 trillion to 36 trillion this cycle. So a tremendous amount of credit's been created through government debt, and its profits have followed. So it's sort of a cycle right now where you have fiscal deficits plus asset inflation equals record profits equals buybacks, which I would love to talk about, equals higher stock prices, and it's a cycle, and then it just goes around and around, and everything looks good right now as long as things stay and not perpetual, as long as things are sustained and there are cracks, but I would also argue, again, like, I was joking earlier about 9% inflation. Those were cracks too. And we've seemed to keep going, finding ways to keep the cycle going. So it's been an impressive cycle. There's no denying that. They've done a really good job of keeping it together.
Um, okay, so a lot of this comes down to, use a word you picked there, sustainability, right? Um, and a lot of talk right now about the unsustainability of the debt. I just know that people have been warning about that for decades. I agree that it is unsustainable. I just have gotten to the point where we just do not know when that breaking point is. Is it 36 trillion? Is it 46 trillion? Is it 66 trillion? Who knows? So that's a hard one to use as a timing perspective. But there are a couple of things you mentioned there. So one obviously is fiscal spending, which continues, at a very high rate. Now there is a lot of lip service in this current administration that they want to kind of get that reined in. Um, who knows if they will or not. I will note that from a monetary side, we have had some restraint there, right, over the past, 2 years or whatever, right? Um, so the monetary spigot sort of got turned off. Monetary stimulus spigot got turned off, and it hasn't really mattered all that much yet, at least.
Well, you know why, Adam? I mean, you know why that hasn't mattered? Because investors know, they know the Fed will come back at any moment to the rescue, just like they did when, the banks started unraveling a couple of years ago.
Hmm.
They'll be there. Everyone talks about Taco, about Trump always chickening out. We call it FACO. The Fed always chickens out. They will be there as soon as there's stress in the market, spreads widen, or we have a failed treasury auction. I promise you, the Fed will be there to backstop the markets. So even though they haven't, really didn't raise rates too much, and they have ended QE, they'll be back. And I think the markets know that. And I think that's why asset prices or inflation have held up so well in the face of many uncertainties. Um, so yeah, it's kind of I in a blog post I wrote about the market's paddle. There used to be a time when the market would Mr. Market would paddle you when you did some badly timed investments or made some bad decisions. It was a disciplinary, it helped the markets. But now it's the Fed has the paddle, and if you don't play along, you get the beating. So I just think knowing that there's that Fed put is what keeps a lot of this together, and the Fed will be back, and then you have to kind of take a few steps forward when they come back, just like when they cut rates by 100 basis points uh, not too long ago. What's going to happen to the bond market, and do rates actually go up? So that will be interesting. I just want to fast forward to that point. Let's get it over with. I would love the Fed to cut rates to zero tomorrow, and we could just find out how the market would respond. So, but they'll be back.
All right, so that's obviously one support that well, the market is continuing to count on, as you just said. Another one is beyond just the monetary and the fiscal side is the corporate side, which you said the buybacks, right? Which is they have grown, some would say metastasized to just a gargantuan level. And we can really see in near-term market trends when we enter a buyback window, blackout window, and then when it reopens back up, just the upward lifting effect that buybacks have on these asset prices. You said that was something you were interested in talking about. So what is it specifically about buybacks that you want this audience to know about?
Um, just how large they are, and how big of an impact they have on the stocks. The ones we trade, even, we notice the ones that have buybacks and the ones that don't, how they act, how they trade. Buybacks now are, approaching, if not exceeding, a trillion. Is it a trillion? I think it is a trillion now a year. And there's a lot of talk about passive and how much passive has influenced stock prices. Buybacks are 2 to 3 times as large as passive net flows. So these are another set of price insensitive buyers. They don't really, they'll pay lip service to it, but they don't really care. If they have a certain amount allocated to buybacks, they're gonna gradually buy that back during the periods that they're allowed to. You look at something like an Apple. They have a huge buyback. It's $100 billion relative to its market cap. It's really not that great. It's about 3%, but they also benefit from the passive flows.
Right.
So I think the where you want to be if you're a short-term trader, or maybe you're developing an algo that likes to front run, you want to be in stocks that have buybacks and get the passive flows, because now you have two price insensitive buyers. And I think that's one of the reasons the large caps have done quite a bit better, is they're benefiting from the passive and the buybacks, where the small caps have not are not getting the passive flow. So you actually have to, fundamentals. You have to do the work, and you have to earn it the hard way. You're not getting that passive flow, and on small caps as well. Earnings have been declining now for 2 years, at least on the benchmark we use, and a lot of the companies we see. The mega caps haven't had that, and a lot of that has to do with the huge AI spending. but small cap earnings have rolled over from the peak of 21, 22. So they're not with the profits rolling over, they're not getting the passive. Now a lot of them aren't doing the buybacks. And then you wonder why they haven't done anything in 4 years. So a lot of it is flows, and we see it with the companies we follow, and the ones we own even, when if they ever stop buying back stock, like you just don't even say it. Because if you say we're done with buybacks, it's like it's game over. The is not going to do well. So it's very interesting. And when we trade, we trade quite a bit in these small cap stocks. Um, it's like you're always fighting these little algos. Like there might be a lot of volume in some of these names, but there's not a lot of liquidity, if that makes sense. So you have these little tiny trades going on. Um, and I can't, I have no data supporting this, but I don't believe, like I wrote a blog post called Prices Aren't Real. It just feels like when you're actually in a market and you have a block, you want to buy or sell, there's no one there. And that is from the growth of passive. Passive now is bigger than active. And so there aren't the blocks there used to be. So you'll see stocks with good volume, but when you go to buy or sell, like, whoa, it's like crickets. I'm not trying to sell 14 shares. If I was, it would be quite a bit easier. But that's what's being traded right now. And I know I just went on a totally different subject, but I think that's important too. But the buybacks are part of that liquidity equation because they're a known buyer. They don't really care about price, and they're always, not always, but often there during certain periods. And the passive is another monster that seems to always be there as long as the flows keep flowing.
Okay. And again, for folks watching who have watched previous videos here on this channel, the passive flows that Eric is talking about, this is the giant mindless robot that Mike Green talks an awful lot about. So I won't.
Which fluctuate, but I think the last time we looked, we're about 2 to 300 billion. It might be closer to 400 now because I know they've picked up recently. Where buybacks, again, are closer to 1 trillion. So two pretty big, buy price insensitive buyers on a total market cap. What is it now? 60 trillion for stocks, maybe 70, depending on what you use. So it's not huge when you think of it from that perspective, but as an incremental buyer, and if you don't care about price, it's a big deal.
Well, you have to remember that stocks are priced at the margin, right? And so if the dominant marginal buyer every month after month is a price insensitive buyer, as you're saying here, that does add a lot of continued upward price pressure. So let me ask you a couple rapid fire questions coming out of this. So first off, just on buybacks specifically, just want to get your opinion. They used to be illegal. They were considered price manipulation. What is your opinion on buybacks? Should they be allowed, or is it just gimmickry?
I used to love buybacks, and they just weren't this pervasive. But somewhere along the line, they went from buying a stock at a discount, just like an active investor would try to do, to that consistent bid, and the valuation sensitivity went away somewhere down the line. And it no longer went from trying to increase the intrinsic value per share of a business to just having a buyback, and just keep cranking up the stock, and a lot of that, of course, is tied to executive compensation.
That's where I was going to go,
Um,
where it's really in their interests more than it is the actual shareholders, right?
for sure. And I can't tell you how many companies we've seen spend millions of dollars on buybacks and then eventually need that capital. I mean, badly. Big Lots is a good example where they recently went bankrupt. There's going to be a lot of consumer discretionary companies that did extremely well in 2001, I mean, 21 and 22, due to all the COVID stimulus. Earnings were booming. And what did they do with the money? Instead of setting it aside for a rainy day fund, which you would think after COVID, companies would realize they needed, um, instead of that, they bought back stock. We have so many consumer discretionary names we follow that the stocks are down 30, 40, 50, even more percent, to where they could almost go private right now if they had kept the capital from buybacks.
Mhm.
And unfortunately, a lot of these are going to go bankrupt. And if they didn't buy back, and then the CEOs will lose their jobs, and some have already. But they did very well in their
They
stock,
already
during
padded
that
their
period.
pockets.
They,
Yeah,
they don't,
and
there's no clawback on buybacks, and there's no write-offs on buybacks. There should be. So another blog post we wrote was the buyback wall of shame, and I think when the cycle ends, there's going to be quite a few more that join Big Lots.
Is this somewhat similar to on the private equity side when, you do a big LBO of a corporation, you saddle it with a bunch of debt, and
Yes. Yes.
basically you're just hollowing out the company, right? Because everything's
Yes.
going to pay the debt, and then the private equity firm flips the company at some point in time, and they made out like bandits, but you got this shell of what was there before.
Very similar. And you have the investors encouraging them to do it. So we're not all we could all share some of the blame. When I say all, and I'm just including investors. In these conference calls, uh, a lot of these analysts are encouraging them to buy back stock. And maybe if you trade through our desk, that's even better.
Hmm.
But no. We're all kind of in this together. Buybacks have helped this market considerably. So it hasn't just been executives that have benefited. It's been many of the funds and investors that invest in basic ETFs.
Okay. So let me ask you this then. I talked about the folks that are throwing away Benjamin Graham's book. Um, what would you say to them? Like, why take the value route here? Why not just learn to love the bomb, just let liquidity work for you? And yeah, I'm going to buy these large cap names that are doing massive buybacks and just let this thing run for me.
I don't know what I would advise them. The cycle's gone on so long that we acknowledge that we could be wrong, and the Federal Reserve could continue to monetize debt without consequence. It could keep everything elevated, inflated for an extended period, but we don't believe that. But we're aware that it could happen. So we don't want to tell everyone, get out of whatever you're in and get into our fund because maybe we're wrong. It's possible. We don't. I mean, we certainly don't believe that. But I would go back to just past history. This isn't new. The only thing that's new is just kind of this is a really long cycle, so it's a little different. And the intrusiveness of the central bankers, this is new. I mean, they didn't use to print money to buy bonds and corporate bonds even, and who knows if they'll buy stock next. Um, so in that regard, it's different. But if you look back in history, not one cycle in the history of mankind has been sustained. It's always ends, especially cycles driven on credit, which most are, and this one is. But people believe, I think, that are fully invested now, that they'll be the ones that identify the turn and they'll be able to get out. And we always get asked, why should I pay you to be in cash? And we just say, you don't have to. You don't have to buy a fund. But we always say it's usually self-evident after a cycle ends why you would do that. And that's protect capital and then get aggressive and opportunistic. You can't when things are crashing, you can't. It's hard to sell things and buy things. And you really need that liquidity. So you go back to 1999, 2000. We had that same feeling as we have today that it will never end, and investors are euphoric. There really wasn't a bell that rung. In March of 2000, I remember just coming to work, and one day everything changed, and the internet stocks were crashing. Instead of going up 10% a day, they were just getting destroyed. Um, and I don't know if there's enough investors that either remember that or appreciate it, or just how quickly things can change without a catalyst. See, everyone's looking for a catalyst. In market cycles, you don't always need one. I mean, the housing bubble is different. I think we did have catalysts. You had Bear Stearns going bankrupt, and you had mortgage credit growth start to slow, which was driving everything. Um, so that you did. I remember '07, you could see earnings starting to roll over. So you had almost a year to prepare for that one. But we're not all. This isn't a catalyst or a bell doesn't have to ring. I think that's important for investors to understand.
Okay. Well, so that gets to the question of, again, catalysts. And if I took good notes here, really the thing that determines pricing in a market, even one that's as, maybe not as traditionally priced as the market is now, is earnings, right? And so if earnings outlooks get compromised, prices will have to adjust accordingly. So I'm going to read just a section here from a recent post that you guys put up at your website, which was titled "It's Affordability Stupid." And there are a lot of great points in there, but here's one sort of high-level section I wanted to pull out here. While macro data may point to an economy that appears resilient, with moderate nominal growth, low unemployment, and steady consumer spending, beneath the surface, an affordability crisis is building. Though it may spare those with inflated assets, it is marginalizing and demoralizing a vital portion of the US population. It's another unsustainable trend built on years of easy money and an overemphasis on financial stability, i.e., keeping asset prices inflated. Like stock valuations, corporate profit margins, and government debt, we believe today's affordability trends are overstretched and will inevitably break. So let's dig into that if we can. Can you talk specifically about the affordability crisis that you see here?
Yeah, and again, we always look at things from the bottom up. Cracker Barrel just announced earnings, I think it was a week or two ago, and they announced positive comps of 1%. And the stock was up. I mean, it was up big on. I mean, it was up like 10% because that was a big deal because these kind of middle end restaurants, they haven't been performing very well. So positive comps was really great. But beneath the surface, pricing was up 6%. So you've got mid single digit negative growth in traffic, and so you're raising prices. Your earnings are at least stabilizing, maybe improving, but you're pricing out a certain percentage of the population. And this is a really big trend right now in corporate America, the premiumization strategy, which is to sell to the affluent, the higher end. I mean, even I'm sure you've read this or seen this, that even the dollar stores are benefiting from selling to higher end consumers now.
Mhm.
So the more you price out, are we going to price out the lower middle class from going out to eat? I mean, if this continues, that's what you're doing, and it may benefit profits, but what does it do to society? And again, we go back to sustainability of the cycle. I just don't think this is a sustainable trend. Look at the airlines right now. They're tearing out a lot of the economy seats and replacing them with business class and first class. So are we eventually going to make air travel affordable for the affluent only? I mean, I know that's extreme, but that's just a good example of what the businesses are doing now. They've learned that they can make more by doing less. And a lot of that came from COVID. You had all the asset inflation from COVID, but you also had supply constraints. Companies were having difficulty meeting demand. And eventually they learned, well, let's just not meet demand. Let's just raise prices. And it's okay losing the lower end. And promotions, were taken away. My one of my favorite hobbies is BOGO shopping. The BOGOs were taken away, and yeah, so you're intentionally taking away from a large percentage of the population, but not a large percentage of the population that has wealth or accumulated wealth. So it's a dispersion or disparity, the wealth inequality trend that continues to build. And at some point, where do we end up there? I mean, and that trend is not going away on the corporate side. That is a very popular trend that we expect, as long as asset prices remain inflated, to continue. And then real quick, Adam, like Toll Brothers is a great example. They're known for the higher end homes. So they're kind of pricing everyone out to begin with. Their average home is around $1 million. But what's interesting is in their commentary, they talk about how higher interest rates really haven't affected them, because their average customer has so much wealth. They'll either buy the house for cash, almost a third or so do that, um, or just they have huge down payments. It's not a big deal. But what is a big deal to Toll Brothers, and I'm not sure they fully appreciate it, is the stock market. So as all these companies like the airlines start to gravitate towards this premiumizing their services or goods and services, they're really setting themselves up to be maybe too dependent on volatile asset prices, which
Hmm.
have gone up for so long that maybe the perception is they'll never go down, and we can position ourselves this way because uh, this is going to be sustained. It's a new plateau.
Let me actually pull right on that directly. So, as the economy becomes more and more dependent on a smaller and smaller percentage of the population that has more and more of the assets, right? Most recent stat I read, this is now old, it's probably even worse now, but I think it was 93% of all financial assets were owned by the top 10% of households, right?
Mhm.
So already highly concentrated. To your point, that works great right up until your affluent consumer starts tightening their own belt, right? So to your point about the stock market, should the stock market correct, well, who is that going to hurt disproportionately? It's going to hurt that 10% that owns 93% of all the financial assets, right?
Yeah.
So if all of a sudden those folks that you're depending on to just keep buying more and more and more, all of a sudden cut their spending by 20%, a third, half, whatever, depending upon how bad a market correction you might have. You got a huge, an increasing part of the corporate fleet that is dedicated to those people.
Yes.
Yeah.
Yes, and we're seeing that from the bottom up. And then the flip side, the argument for asset inflation or growing economy through wealth, the wealth effect is, well, look at how low unemployment is, 4%. So that's really good. But what if you price all of these workers out of basic necessities? They can't afford homes. I was getting my hair cut, and the lady was telling me about how she was so frustrated that she'll never be able to afford a home. So instead of saving for a home, she went to London on vacation.
Hmm. Yep.
So I
Yeah.
think you're
Doom
reaching a
spending.
point
Yeah.
where cut your own hair. um, you can't just give half the population everything, um, and reward them for what? Just owning overvalued stocks. You're not
Yeah.
really. People will say, "Oh, I earned it." Well, I don't know. Did you
Well,
did
you
you
had a
earn
lot of
that
help because
that
the
that
system becomes
multiple going
dependent
from?
on higher prices. And so it's
Yeah,
always trying to engineer higher prices to benefit.
yeah,
It reminds me a lot of when I lived in Manhattan. I started my career as a junior investment banker on Wall Street, and there was this narrative in Manhattan that I think has only continued, which is, well, we have to pay the bankers well, right? Global financial crisis, right? 2009, right? A lot of good arguments that is these big banks and their reckless lending policies that really engineered that crisis. And yet, in the depth of the great financial crisis, they paid themselves record bonuses in 2009,
yes,
right? And the
yes,
the rationale was, well, we can't pull their bonuses because they're such big spenders in Manhattan. Everybody depends upon what they spend, right? And it's kind of like, who anointed these guys the untouchable
yes.
kings, right?
That's right. That's right. But the market's gotten so big, asset prices are so high. Um, it is now, a threat to the system. If stocks were to decline 50% from here, what would happen? It's the classic too big to fail. Um, but I know you're a fan too, but I love James Grant, and I think one of his famous quotes is, why don't we just try capitalism?
Yeah, I know. Creative destruction. Yeah.
And free markets, I mean, let's let it rip. Let's let it do its thing. But every time we get close to letting capitalism or free markets cleanse the system, get rid of the malinvestment, what do we have? We have the Fed come in with their heavy hand and bail everyone out, and the rich, get to fly first class, and the not so fortunate, um, maybe don't even get to fly now. So
They don't even get to
yeah,
fly. Yeah,
it's a trend. It's a trend we're seeing, and I hope it corrects itself without a significant correction in the markets. I'm not sure how that all unfolds.
I was gonna say, I don't think you've got confidence that it will, right? It seems to me you're betting your money on in your 70% T-bill position as you think it's going to be something a little more painful.
We think this all is going to end. The deficits, the asset inflation, which are driving corporate profits, which are driving stock prices, it's all going to end. And that's one of the reasons we launched. We launched in 2019. It's been over 5 years, and but we wanted to have a strategy to be able to take advantage of what we believe are going to be very large opportunities. The numbers are so much bigger this cycle as far as debt goes, all of the spending. Um, so we think the opportunities will be that much bigger. And the opportunities were wonderful in 2009 if you had the liquidity.
So sorry to interrupt you here, but let me ask you this. So back in 2019, I could have had a similar discussion with you about how there were a lot of unsustainable trends, that market valuations were pretty rich, and that a strategy like you're talking about could work pretty well, right? A value-based strategy of let's wait for the correction and then let's deploy and buy really good quality companies at really attractive valuations. What you didn't anticipate, and it's no fault on you, nobody could have seen it coming, was COVID and the gargantuan amount of trillions in stimulus, both monetary and fiscal, that were unleashed, right? So I guess kudos to you and your firm for staying alive through that,
Right.
because that was the complete,
Half the
like if you
battle.
said, what's the worst thing that could happen to our thesis? That might have been, right? Okay, so now we're on this side.
Real quick,
And
Adam, COVID actually helped us, and that's not the catalyst we wanted. But small caps during COVID collapsed 40%. And we were able to get half the strategy invested. We're actually up 19, 20% in 2020. So that was I mean, obviously not a catalyst we wanted, but it was a catalyst of volatility nonetheless. So this strategy can weave around even though we haven't had we call it the main event. There's been moments over the past 5 years. Higher for longer was another one in October 23, and then tariffs as well. But still, this isn't anything like what we expect will eventually happen.
okay, and that's where I was going, which is kind of the main part of your thesis hasn't happened yet, but now with the dust settling, mix all my metaphors here, the pig largely through the python, you are now saying, okay, we're kind of back to where we were, where we've got richly valued markets, maybe richly overvalued markets. We've got value stocks and small caps out of favor, not necessarily cheap, as you were saying earlier, but out of favor. But the risks in your mind, I think, here substantially outweigh the rewards. Hence, you're sitting on dry powder, and you're going to more or less find opportunity where you can in the interim, but wait for that main
Yes.
event and then deploy.
Yes. It's good.
Okay.
It's good. Good summary.
So as we start to wrap up here, just as you look into your crystal ball, let's just next year, 6 months. Feel free to go out 12 months if you want, but what's your general expectation from the market here?
It'll be interesting. Earnings are going to be interesting. Things did slow down in Q1. I know there's not as much concern about tariffs because it hasn't been showing up in the CPI, but a lot of the companies we follow have 90 to 120 days of inventory. A lot of them are waiting to see what happens before making a decision on pricing. That's eventually going to flow through. It's going to be shared. It's not going to be stuck all in the consumer. The vendors, the manufacturers, distributors, they're all going to take a cut. They'll try to reduce costs and productivity as well. But that's probably going to show up later this year, Q3, Q4, how companies respond to that, and then how consumers react to that. And from what we're seeing, half of the population is not going to react well to that if inflation picks back up, while the other half won't care
Hmm.
as long as the S&P 500 and the Nasdaq the QQQs stay where they are. So it's again, all these trends continue to get stretched, When any of them snap, we don't know whether that will be the bond market or even the stock market could correct without warning. Because again, Adam, there's no valuation support under the stock market. There's none. Stocks go down 5% on tariffs. I mean, that's not really. Now you go from a Schiller 37 to 36 PE. Now your earnings yield is 2.7%. Or 2.8% instead of 2.7, and the risk-free rate's at 4.4 on the 10-year. There's a lot of room for stocks to fall to get close to any kind of valuation that makes sense on normalized earnings. And I would say one of the main points we would like to make is earnings are critical, but the earnings you're seeing now are so dependent on the sustainability of fiscal spending, which is, over 6 trillion. This was 4 trillion before COVID. Sustainability of that spending, sustainability of debt growth, and the sustainability of asset inflation to maintain the consumption and the margins you're seeing today, which we believe, again, very unsustainable. I had a friend real quick, I know we're running up against time, but he was a big proponent of balancing the budget, the fiscal deficits. He's like, this is a big bill. This should be, the spending should be cut. And I know him well, and I know how he's positioned. His investments are positioned, which is highly in equities. And I said, well, if we balance our budget, corporate profits are going to tank, and you're going to lose a lot of money. But it's easy to talk about deficits, but I don't know if everyone's really connected all the dots of how much we're spending and how much that's impacted corporate profits. Again, pull up a chart of the fiscal deficits or the government spending and the government debt growth and put it next to corporate profits. It's almost perfect correlation.
Yeah, yeah. I know that's been very true. And to your point, kind of too big to fail. It's like, have the deficits become too big to cut, right? Because the market is so
Yes.
dependent on it, right? All right. Well, look, Eric, great talking with you. I'm going to send Dave Collum a note of thanks for connecting us here. So what I hear you basically saying, and this is not unfamiliar territory. I've had lots of discussions like this, is that there's sort of a sword of Damocles that is hanging over this market, right? Which is the high level of overvaluation. As you said, there's not a lot of what do you say, valuation support under stock prices today. So for a whole bunch of reasons that we've discussed, that thread that is holding the sword looks like it's unraveling. Thing is, we don't know when that's really going to break, right? So it could be tomorrow, it could be 5 years from now, right? We don't know. It's going to be dependent upon a crazy amount of factors that we can't project out with confidence here. So first off, I'd like to just tell you, hey, I'd love to have you back on the program again in the future, so you can kind of give us an audible call about where things are in terms of your outlook. And obviously, if you get to a point where you say, hey, we now think that thread supporting that sword is about to break for reasons X, Y, or Z, let me know. We'll get you back on the program swiftly.
Yeah. And it's interesting you bring that up about the sword over our heads. And throwing away Benjamin Graham's book. Maybe it's a good time to have a margin of safety.
Yeah, absolutely. Well, I think I've made this call, but I'll make it again here, which is I'm going to predict that at some point in the not terribly distant future, there's going to be a trend on TikTok saying, hey, the most useful bit of financial advice you can now get is to reach in the garbage can and pull that book back out.
Don't throw it away.
Yeah. All right. Well, look, for folks that have enjoyed this conversation, I'm guessing for many, it's the first time that they've been introduced to you and your thinking. Where can they follow you and your work between now and the next time you come on this channel?
We're at palmvalleycapital.com, and we write a blog every month. And Jamie Wiggins, the co-founder, he writes an incredible quarterly letter. So just check us out, and hopefully you find it at least interesting.
All right. And you were very kind when we when we got on before we turned the camera on, and told me that you had actually been a listener of this channel, which was wonderful to hear. But that specifically you listen to it when you're making spaghetti for your family on spaghetti nights. So hopefully when this comes out, you can maybe listen to it while you're making your next meal.
That'll be kind of weird. I don't know.
All right. Well,
But
look,
I
folks.
appreciate it, Adam. I really enjoy your show.
Well, that is very kind of you to say, and I'm so glad that you came on when I decided, were willing to come on when I called you out of the blue there. All right, well, look, folks, if you have enjoyed this conversation with Eric, please show him that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Folks, if you don't yet subscribe to this channel, there's lots of reasons to do so. An important one is if you want to make sure you don't miss an episode, if you subscribe, that's how you get alerted when new videos go out. But we are getting into the summer months. Those of you who might remember, I did this last summer. My birthday is at the end of July, and I would love to close out the month at an important milestone. Last year, we crossed 100,000 subscribers. This year, trying to get to 150,000 subscribers by the end of July. So if you are watching this and have yet to subscribe to this channel, please do make sure you hit that subscribe button down there. Also, if you took good notes here with Eric and think are like-minded with him and would like to try to figure out how to navigate your financial wealth through what might lie ahead, especially if we end up having some sort of large corrective event like Eric thinks could happen here. Highly recommend you get that help from a good professional financial advisor. Importantly, one that takes into account all the macro issues that Eric has talked about with us here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd even just like a second opinion from one who meets that criteria, then consider scheduling a free consultation with one of the financial advisory firms endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out the form. These consultations are totally free. There's no commitment to work with these firms. It's just a service they offer to try to be as helpful as they can. Eric, again, thanks so much, my friend. I really appreciate getting to know you here initially. Looking forward to some future discussions with you here to dig a little bit more deeply into your approach and your outlook. But for folks who watch this channel, and most of them are just regular people trying to grow their wealth prudently, but most importantly, trying not to lose it all in some market event like you're afraid could happen here. Do you have any parting bits of advice for them?
Think independently. Sometimes trusting your gut's not a bad thing, and if you believe stocks are overvalued, you don't have to be investing. You don't always have to be doing something in investing. Sometimes waiting it out, or if you're not sure, if you're uncertain, don't feel forced to do something.
That's very well said. And I say this from time to time with the financial advisors that come on this program. One of the reasons why I pick them, folks, I have them here just to serve as models, right? To say, look, I think you should look for a good financial advisor. People say, well, what does that look like? So I bring them on and say, look, I think these guys are good. Feel free to talk to them or find somebody even better than them, right? But I'm trying to establish a benchmark. And one of the things that I look for in those firms is their willingness at times to say, hey, look, we don't like the risk return of the market right now, and we are more in cash or T-bills than we normally are. And a lot of financial advisors won't want to admit that or won't even want to do it because they
No.
think, well, my clients could be in T-bills on their own. And if I tell them
Yes.
that I'm in cash, they're just going to say, well,
Yes.
what do I need you for, right? And the thing I remind people of is you want to pay for the expertise of when to be in cash and when not to be in cash, right? You're nodding as I'm
And
saying
Adam,
this.
it's an important part of the strategy that we really didn't touch on, but it's and why no one really does it anymore. This old school way of investing is there's just too much career risk. Um, so if we stay invested this way for too long, we could lose all our assets. So a lot of people just will never do this. And I've worked for some large firms and other firms throughout my career, and some good ones. But in the industry overall has tilted so much to relative that this way of thinking and investing, it's not just old school. It's just too risky from a business perspective, not an investment perspective, which I think we carry quite a bit less risk. But from a business perspective, it's too much risk for many to handle.
Yeah, it's crazy. So this is obviously I'm taking notes on what we'll talk about the next time you appear on
Yeah.
here. We have all these, you hear the term malinvestment. I think we have a lot of malincentives in the financial
Oh,
system right now, and that's a good
no
example of
doubt.
one.
No doubt. Yeah, agree 100%.
All right. Well, I've really very much enjoyed this, Eric. Thanks so much. Look forward to having you back on in the future. Really appreciate it.
Thanks, Adam. I appreciate it.
All
Take
right. And
care.
everybody else, thanks so much for watching.